Hey, this is Sasha Evdokov, and thanks for joining me for another episode of Let's Talk Stocks, episode number 100. So thank you so much for sticking with me. If you've been watching my episodes consistently or listening to them on podcasts, truly thank you and appreciate it. Now, by doing these episodes, by doing these trainings, writing the books, creating the courses, in fact, not only do I get to help you guys and help you take your trading game, your investment level, your knowledge and understanding to a deeper level, but it actually helps me think things through a little bit. It helps me get more practice in. So for example, when I'm writing a book or when I'm creating a lesson, I really have to think things through, and I really have to think at things multiple ways and factors. Now, I personally already have my trading system in place as far as trading goes, but I'm always looking to improve and take things to that next level and constantly continue to grow as a trader, as a person. And by doing these kinds of lessons, by improving and teaching and connecting with all of you, in fact, you help me become better as well. So creating that win-win relationship. So thank you so much for helping me do that. And I hope you're also proud of yourself and looking back at the journey that you've taken, especially if you've been with me for quite some time. Now, in today's episode, what I'd like to do is share with you simplifying some trading indicators. And we're going to talk about briefly on some of the indicators like the ADX, the MACD, and Bollinger Bands, and the RSI indicators, as well as just some other regular indicators. And back when I started trading a long time ago, I fell in love with indicators. It was kind of like a little romantic relationship that you have when you're a teenage person and you still haven't had your first kiss yet, because you're really excited about, having a girlfriend. You're really excited about dating someone or going out on a date, and it's just making things really special. But, the fact is that's kind of what indicators become to a lot of traders. Is they're an initial relationship that you get overly excited about, and then eventually it burns or breaks you. And for me, this is really what happened when I started looking at indicators and put too much emphasis and attention on them. So what I want to do in this episode is just give you a step back and show you the bigger picture. Just like if you were to shake yourself, back when you were 16, and if you're still 16, well, hopefully you'll get a little bit of a shaking during this episode. But, most of the time your relationships when you're young, as far as dating relationships, aren't going to work out. And when it comes to these indicators, the same thing goes with them. They're not going to be long-term relationships. So when you use these kinds of indicators, you really shouldn't put that much emphasis on them. Again, I want to emphasize my key thing that I always look at is price behavior. So price is always key. Then volume, which confirms that behavior. And of course, the way that it's acting and behaving. So if it's acting sluggish, the follow-through, sometimes this can be referred to as the price spread. All those things are taken into account. So those are always the key and more important things that I look at. So when we start getting into indicators, a lot of people, they fall in love with these indicators. And I do have a few on my trading platform as a quick little shortcut. But most of the time, as you look at things on my screen, you'll typically notice that they're very clean and neat. There's probably one moving average, if that, on my screen most of the time. And that is because I typically like things very clean. And most of the indicators I can actually get from this screen. Now, for those of you that don't believe me, I'm going to share with you and give you some insight. Now, it's not going to be perfect or perfect insight as far as what an indicator would give you, because an indicator is based on math. But if you've been trading for a while, studying charts for a while, most of the things you can get from a simple chart, you can get the same things that you would get from an indicator. So, and I'll prove it to you here in a little bit. So for me, I like to keep things clean on my chart. I like to get rid of all that circus or all those different variables and things on my chart, because it just becomes very confusing. So let's do a few examples of these different indicators, and I'm going to prove to you how to really start looking at your charts, especially if you're just getting started, to just take a step back, to look at things at a bigger picture and simplify things. Keep it simple. Keep it simple when you're trading and when you're investing, because I know when you're first getting started, you're probably looking for that magic bullet, silver bullet, golden egg, golden goose, whatever your analogy is that you want to use. You're looking for that magic thing. And really, there is none. It's about finding your strategy that works for you. It's about finding your match and matching it up to what your risk tolerance is and what your strategy is. So here, as I look at some indicators, and I have a few that I've done some shortcuts to that sometimes I'll glance over, but there's a lot of indicators that you could put on a chart. And if we just take a simple chart example, let's just say Tesla in this example, since it's a popular company, what you could do to put on an indicator here is hit the plus sign. Now, I'm using TC2000 here by Warden. If you're using a different platform, by all means, go for that. But when I look at indicators, I'm looking at, there's a bunch of different opportunities out there, similar to how when you're looking to buy a car or a camera, there's a lot of variations to what you could purchase. And here you can see we have MACD, we have the MACD histogram, you have the momentum, money flow, moving average, price, volume trend, rate of change, RSI, tricks, the TSV, the volume. So there's a lot of them, the VWAP, and you'll notice some are more popular than others. For example, like the Williams percent or the VWAP is pretty popular. Volume, extremely popular. Stochastics, RSI, these are very popular. The PPO, price percent oscillator, is not as popular, but the MACD is. So here's the MACD, but for me, I prefer the PPO a little bit more than the MACD, and we'll talk about that briefly. But really, you can see there's a lot of choices when it comes to indicators. There's a lot of things that you can do. And as you start stacking these things on, it can become confusing. So for example, if I stack the ADX right here, which is really going to tell you about trend strength, then what I might do is put on a few, let's just say Bollinger Bands. We'll put it on Tesla Motors, so there's our Bollinger Bands. Then what I could do is put on another one, let's just say, here, a MACD. Here's another one, and we can stack the MACD histogram on here. So as we look at, let's just see here where it is. So MACD, here's the histogram, and we can overlay that with the MACD, and we can, of course, change the colors to make them look a little bit better, like some of the other traders will do. So we can do that for you as well, just to make you feel happy. And then let's just see, what else do we have? Moving VWAP, moving averages. So we have quite a bit. I mean, we could put on the RSI. So now I have a lot of indicators, and I almost can't even see my chart. So as you can see, as I start stacking more and more of these things, and of course I could continue to do this, as I start stacking more and more of these things, it really just overwhelms my chart completely. And that just becomes really damaging to making a trading decision, because now when you start looking at all this, what do you do? What do you decide? How do you trade? What is it that's going to create that trading decision? How do you know when to buy and when to sell? Because you have one indicator that's here, another indicator that's over here, and this signal over here. There's a lot of different indicators out there, and you really just don't know which one you're going to buy or sell, or when to buy or sell. So as we look at these things, so ADX, for example, is going to tell you about trend strength. Bollinger Bands up here are going to tell you about the expansion of price movement, the probability based on the volatility of that price movement. They're going to try to contain that price. The MACD here is going to talk about the moving average. It's moving average, convergence, divergence, kind of oversold, overbought conditions. Then you have Williams percent R and RSI, overbought, oversold conditions. So all these things kind of tell you in general similar concepts. And you have lagging indicators and leading indicators, which is some of the things that I go into more detail in my technical analysis blue course. But Leading indicators typically are live and real time, whereas lagging indicators follow behind. So if I go ahead and let me just go to a standard view, here you can see the moving average right here on Tesla. It is lagging. It's behind the price, whereas the price is a leading indicator. The price is what's happening right now. It is real time. Same thing with the volume. It's what's happening right now. And when you look at these things, most of the indicators let's see, we were on the volume side. Most of these indicators are going to be lagging, especially these indicators that you start overlaying on top of charts. And when they're lagging, they're going to give you delayed signal. Now, typically, these indicators are better used for when trends are over. It gives you some indication of an ending or a change in movement in a trend. So that's typically the better approach to using them. But you can use them for entry positions in terms of confirming what you already know. And what you already know should be based on price, volume, behavior, that price action. So that's really where everything stems from. So I've used this example in the past as far as Bollinger Bands go, and I'm going to do it one more time. So let me just pop over here to the RSI, and we'll take this off. We'll put in the volume here since I cannot trade without volume. Volume is pretty much always necessary. But here, as I look at the Bollinger Bands, okay, the Bollinger Bands, and we pop them in, Bollinger Bands here on the Tesla. So you can see here we have the Bollinger Bands on the daily right there, and you can of course customize it to where there's some shading or something in there and stuff like that. So you could customize these things, but in either case, what happens here is on the Bollinger Bands, the simple goal behind these Bollinger Bands is they try to contain the price. Okay, so if we look at the weekly Bollinger Bands, as you can see, as the volatility increases, or the price spread, because price spread, the width of the price bar increases typically when you sell off. As those increase, the Bollinger Bands get wider, and as they decrease, as prices typically move up, but as they move very little, they contract. Okay, so you can see there's contractions in certain areas. So if we look, there's a contraction here, and then we get an expansion over here because of the volatility that comes in. Okay, then we get some other contractions. There's some contractions over here, but then there's also some expansions over here that happen because they try to contain the movement in case the stock sells off. So that's kind of what happens in terms of these Bollinger Bands. So now, how do you really get this or calculate this if you don't have these Bollinger Bands? Well, the Bollinger Bands are calculated based on the price spread. And if you kind of draw this moving average, let's just remove this Bollinger Bands, you can see that the middle is the moving average. So if we remove the Bollinger Bands, you can kind of get an idea, and I could probably draw the overall, let's just say, where the Bollinger Bands would be, okay? And that is just basically depending, of course, the volatility, depending on the price spread. You kind of get an idea of where they should be based on the moving average, okay? So based on the price. And you can see that here probably it would get wider, okay? It would probably get wider over here, maybe a little bit tighter. It hits the bottom over here. So it kind of would look like that. And if you put the Bollinger Bands back, you'll kind of get an idea that it'll probably get close to that. It won't be perfect, but you can see, okay, so I've kind of hit it some points properly and other points not so great. But of course, they'll give you an exact mathematical formula. But you can see I can get a rough idea anyway based on just my own personal calculations and based on the moving average, using the moving average as a guide. So let's remove all these drawings, okay? And now if we remove the 20-day moving average, now let's try and draw in that 20-day moving average. Or let's pick a different chart, let's just say Tiffany's, and let's try to draw in the 20-day moving average. So now I'm doing this completely blind, okay? But what you could do is kind of draw it, and we'll just start over here. So typically the moving average will lag, okay? So it will typically be behind behind the actual price movement. So you can see the moving average here will probably try to catch up, and I'm just starting in this point because it'd be easier to draw the lines. And then slowly we might kind of average out a little bit over here, and we might dip under that moving average, and then it'll kind of probably do something like that. If I had a pencil, I probably could do it a little bit better. This will probably be over here. This will probably be somewhere over here, probably hits that moving average. So something around that level, maybe around there. So I can kind of draw that moving average. And if I put in the moving average of, again, the 20-day, you kind of can get, let's change it to the 20. You kind of can get a rough idea. So you can see right there, I've kind of hit it close. You know, it's not perfect, but it's kind of in that area, okay? So if you take a little more time and you actually did the price calculations, you can get it. So as you could see that without even having any indicators, with the exception of having price, you can simply get a lot of these indicators. You can do the same thing with, let's just say, Williams AD. You can do the same thing. You can do the same thing with RSI, which is one thing that I removed. This is basically overbought or oversold conditions. Okay, so if you go to RSI, okay, overbought or oversold. So you can see here, this one is hitting this resistance point right here. And when it hits that resistance point, you can see right there, it's coming in, and what happens to the indicator. So without even looking at this, you could pick another chart, and let's just take one for the extreme levels of, let's just say, Bristol-Myers, okay, right here. So if we look at this right here, I've talked about this one in the critical charts. By the way, the new critical charts are posted on the website. But you could see that over here, this one, if this price was, let's just say, somewhere down over here, that would probably be oversold, okay? You can simply, look at that chart, and if this price was all the way down here, it'd probably be oversold. Now, right now, is it oversold? It could be getting into a little bit oversold, but I see the volume right here still fairly strong. So maybe it's midway. It's not perfectly oversold, but it's slowly getting into better value. But right here, it'd probably be definitely oversold. Okay, so that one's selling off in a big, big way. Let's take a look and see if we could find one that changed in a large way today. So this one right here, probably on the daily, I'm not sure. It's just, let's see here, 1 day. On a daily basis, it is probably oversold. So let's just take a quick look at the RSI here, and let's just see here. Right here, you could see it's coming into these levels here at about the 20 on the RSI, but that one still has to catch up. So Tesla, the same thing. You could see it's kind of getting into those levels because it's had this rolling effect, but it could probably go much further because remember, these stocks can sell off violently. But in general, what you can see is that these indicators, they can tell you exactly, okay, how far extended you are. But if you're looking just at the price without even a moving average, you could tell that, okay, this pullback is pretty good compared to, this extension that we had. Okay, you can see that from here, from these lows on Tesla in June, when we pop right here for 1 month, if you're popping for a month and then you take into account all this other price behavior, that, a pullback probably about the same amount to where you broke out from would be healthy. And if you had even more selling pressure coming in, a pullback to 150 would be just fine and normal. There's nothing wrong with the stock. Where you start getting into what something's wrong with the stock is now all of a sudden you might see things come back down to the 50 level. Now something's wrong with the stock. But a pullback to, just a pullback, pullbacks are fine. Coming back to something like 185 would be, hey, it's just a standard pullback from this extension that we've had from February, or even this little pop we had from June. So a pullback could be just fine. And even a pullback to 150 could be, well, it's a really great value buy at that point. So looking at this, you can still gauge that, okay, if you're looking at, let's just say, the Bollinger Bands or the RSI or the ADX or the MACDs, you can still gauge it from the price action and the behavior. And if you're looking at price and volume, this is the best way to simplify things, because if you start putting more and more things on the chart, just like we have over here, it becomes really confusing. Now, you can use some of these indicators to help you guide into position. So for example, if I look at this indicator and I say, okay, I'm looking for a value buy, when is this going to turn over? And what I'm going to use is, I'm going to take Tesla somewhere over here and we'll use the February value buying area. So what I could do is overlay, let's just say, the Bollinger Bands. Okay, very simple to understand. Prices are extended. Here we get out of the Bollinger Bands. Okay, so let's just see if I could draw it here. Here you could see we're extended over the Bollinger Bands. We're beyond it on the weekly. Okay, if we take a look on the daily, okay, and we're again just looking at the February lows, you could see that we're kind of, again, you could see right here, we're beyond that extension. So we're past these Bollinger Bands right there. We're outside of it. So probably a bounce is looking to come sometime soon. So that's the thing, is when you're looking at price extensions and prices are so far extended, this will give you an indication. This will give you a clue. Now, could you still have seen this from a moving average? Absolutely. So if I look at a moving average and I do a simple moving average and I do a 20-day moving average, okay, how far extended above or below is the price? So if we look, let's just say in this area, okay, and we're looking in this October to December area, okay, the price from the moving average, I'm just going to draw a few lines on the distance on some of them, okay, and you get an idea of how far extended. So the biggest extension was probably right around this October time. Okay, so that was the biggest extension. If I start looking at, again, let's just say this range now, and now I draw the extension, okay, so I'm just drawing the extension to the price, okay, where are we the biggest from that moving average, okay? Basically, we're the biggest right around February, okay? The biggest line away from the moving average is right there. So you didn't even need the Bollinger Bands, okay? So you could still look at it from the moving average. Now, with volume, it's going to help you tell you when things are starting to reverse, when things are starting to move, and if they're real. Because if you have a pullback with weak volume, things can snap the other way because value buyers are coming in, or somebody else could be stepping in. But you can see how using these indicators, if you have a Bollinger Band on, how it'll help you to kind of gauge that that movement. And let's just add in back the moving average, simple moving average. We'll do the 20. Now the settings for these are different for all kinds of different things. You could make them a lot different. So it just really depends on what settings you're comfortable with. Right now I have 2 standard deviations on the Bollinger Bands. Of course, I can widen this out, which will contain more of the prices, but it is wider. So if I go to 2.5, it's a little bit wider, but it contains more of the prices because they try to contain. So this gives you some insight. So what I'll do typically is when I'm trading is let's just duplicate this tab. I will typically trade or look at things without any indicators, just like this. Moving average, it's the chart and the volume. That is it. That is the way I trade. And what I do is when I'm looking to take on a trade, I might go ahead and take a look at real quickly the Bollinger Band. And I'll just see, okay, how is the Bollinger Band looking relative to where I want to get in on the value play, okay, right here. Okay, let's just say I'm ready to get in. I kind of want to get in somewhere around this range. Stock's still pulling back, but it'll probably snap sometime soon. Okay, after I did all my analysis, evaluations, everything like that, I'm looking at, okay, is this a good point? Is this a good value buy? And when I look at it, then I go to the Bollinger Bands and I see, okay, well, it's coming into the extreme levels. You probably get a snap there, but you might get a little bit further continuation, but it's getting into those extreme levels, and we could snap back to, let's say, 205 or something like that. So that's how I look at it in terms of taking an indicator and starting to apply it. But I do all my analysis first ahead of time. I do all my analysis first without any other indicators, without any other lagging oscillators or any other indicators, just strictly price and volume, because that's more important. And when you look at choosing an indicator, it's like choosing a match for you, for your date, for your relationship, for your spouse. It's about choosing the right indicator that works for you. And it's just basically something you just glance on, though. It's not something that you're going to constantly be looking at and making full trading decisions on. You're just kind of glancing on, but you want to stick to one or two that you're comfortable with. So for me, what I like to do is I have a few indicators here at the bottom of the screen. And what I'll have is I have a MACD that I'll scan and look at, and this one works a little bit differently. I don't have time to get into all the specifics of getting into a MACD, stochastics, all these Bollinger Bands, everything. This is just a big overview of how you should use indicators. But in general, I'll skim the MACD. But again, this is already when I'm getting ready to get into a trade or getting out of a trade. And I'll see, okay, let me just double check some things. And then what do? Then I check, okay, are things reversing? And sometimes because these are lagging indicators, you'll see that right here, for example, as we were looking to get into Tesla, you might see that that indicator is coming in a little bit later. It's coming in a few days later right here, because the crossover, because on this one you're looking for a crossover between the 12 and 26 moving average. Okay, you're looking for things to cross over, and when it's almost crossing over that other moving average, which again is one of the examples I like to use when I'm talking about, a basic trading system. Crosses above the moving average, get in. Crosses below, get out, or go short, wait for it to cross again, get in, and ride it until it crosses below. So you could use it as simple as that. But here, when you're looking at it, you can see this is a little more precise. So it's giving you an indicator right here that now the short-term bullishness is getting ahead of the longer-term bearishness. And right there's the crossover. So that's your signal, and you can see that also on the histogram right there. So if you look at it right here, there's your movement, and then also right there's your crossover. So when you watch those things, your entry point somewhere right around here, you're not going to be perfect. And now you ride it. You ride it until potentially you get another crossover. Now here you have a fake out, which sometimes happens in the crossover, and that's why I like price action and behavior, because here, right here, if you looked at it, this was just fine. If you're looking at volume and price action, this was still just fine for a little while, but it's showing you that things are getting weak. You can see right there, things are getting a little bit weak because you have this empty spot right there, and you have a slight crossover. You have your second crossover right here, which tells you to get out, okay, right around this region. And then later, what happens? Well, we slowly start the pullback. Now, if you've already taken shares off into strength, let's just say you took 3 times the profit, you might be fine for that stock to come back here again, up to the point where now you get back in and buy more shares right around this price level. So for you, it could have worked out just fine when you would have done these kinds of strategies and systems. But it really just kind of comes down to how you're planning, how you're strategizing based on these indicators. And for me, I don't put that much importance into them. The way that I do it is just the way that I've shown you right now, is I'll glance at them and I'll say, okay, how is it looking for my position? Then I see, okay, is it ready to cross over? Is it crossing over? Good, I'm in, done, next. Okay, then what I might look at is, okay, I might look at, let's say, the let's see, I've changed some things around now, playing around with the charts. I might look at, let's say, Williams AD or Williams percent. And, you start looking at other things, overbought, oversold conditions. So again, you're looking at these different price levels and you're seeing overbought, oversold conditions. But really, I'm just looking at very simple things, and if I'm looking at the RSI or let's just do ADX here. The ADX, it also tells me the trend strength. So then I might check, okay, how strong is that trend? But really this comes up from, what does the ADX really stem from? If you look at how the calculation is done, it's done through the price. It's done through the calculation of the price. So it's basically a bunch of the upticks and the high ticks, and then you calculate it, and it gives you the ADX line. And once you get that calculation, it plots it on this line. So you can change these variables, of course, but in general, what does this really mean? Okay, you get all these indicators, you get all this data coming into your mind, but you still need to make a trading decision. And that's where I find a lot of people lack, is that you get stuck. You get stuck into choosing an indicator, into choosing what to use. And really, that's when I got frustrated and I cleared my chart. And I said, okay, I'm done with this. I'm going to use something simple. We'll just go down to volume. We'll go to price and a moving average. And once I started doing this, everything else started to fall into play, because now I started to understand the charts better. Okay, so if you're struggling, if you're getting confused and you got one or two indicators on, you're probably overdoing it at the beginning. If you're trading less than 3 years and you have already more than just volume on and a moving average, you're probably overdoing it, because now you're going to be confused on when to enter, when to exit. So in my case, I got rid of everything except moving average 20-day, and that is because it gives me a nice little average. This is the simple, not the exponential. And I use 20 also because it's a line of support and resistance for many people. And then also I do the volume, and I also do this actually 20 days. Okay, and the reason 20 is because there's 20 trading days in a month. So I'll put the moving average there on the volume, gives me a nice average on the volume, and this is how I look at things and how I look at charts. Now, I put together a lot of things. I look at price patterns, I look at chart patterns, I look at where's the resistance, where's the swing points, how wide is the price spread. So you start looking at all these things and you start evaluating and you start seeing different things, how far things are extended, what's the price action, how's the volume behaving. So you put all these things together. And then for that, after you do all that evaluation and analysis, then I might look at, let me see how the Bollinger Band is. Is it getting into oversold conditions? Let me take a quick look at the MACD. Where are we getting ready to bounce here, or are we kind of getting into this toppy action? Or are we at those highs? Are we overextended? But if I was in Tesla, and I was in Tesla from February to April, when else has this happened? Let me go to a simple chart. In Tesla here, when else from February to April has a run like that happen? I mean, any kid could look at this and say, yeah, it's pretty extensive. The run has been pretty large relative to the past. I mean, that's a pretty sharp line. I mean, if you look at a roller coaster going on the upscale, right before you dive right back down, that's a pretty serious incline right there. The steeper the angle, the harder the drop. So if you had an incline kind of like this, that's a little bit more logical or reasonable. So, you start looking at it, okay, what's a logical or reasonable kind of retracement or pullback or incline or movement? So if you get something that's moving, let's just say almost straight up, yeah, that's pretty extreme. So chances are we're overbought, and then if I look at something, let's just say here on CRM from November to February, yeah, that's probably oversold relative to the past. We've been moving kind of sideways, and then February, November, December, January, February of 2016, yeah, that pullback probably, yeah, we're probably oversold. Look how far away that is from that moving average right there. Yeah, so you get that snapback. So you don't even need these indicators. I know they seem like they're the magic formula, but using your brain, logically putting these things together is really all you need. And then what you do is you pick one or two and you slowly start putting them in. And for me, I still use only probably 2 or 3 at most. Okay, Bollinger Bands, MACD, PPO, RSI, Williams AD. Those are kind of the main ones. And even then, I rarely look at them. I'll look at them probably once or twice a week. And by once or twice a week, I mean literally on 1 or 2 stocks, just once or twice here and there, and that's it. Probably 10 minutes for the whole week that I might look at these things, or 5 minutes, if that. And that is because most of my analysis and decisions are made from the volume and the price action and the charts. And then I'll just glance at these to say, okay, let me see where's the extreme level. Yeah, look at this. Salesforce, little bit way beyond the Bollinger Band there on the weekly. Okay, so if you look at it, yeah, that's a little extreme. Probably we're due for a little pop. And what did we do? Yeah, it came back. So the same thing here on the daily. So again, the daily, yeah, we're way beyond outside of that range. We're 2% that this is likely to happen, and it happened. So chances are it's going to snap back. So that's the thing. And then you can do the same thing with the MACD. Okay, so you look at it, okay, we're getting into that level, and then you see the MACD right here crosses over, right here crosses over, and then where are we on the Salesforce? Right there in February, again, crosses over, and the moving average crossed over right there too. So, you get into those levels and those price behaviors that really, you can figure these things out without these indicators. And some of the time, I mentioned the PPO. I like using the PPO rather than the MACD sometimes because if you use the MACD, it doesn't average things as well, whereas the PPO can sometimes average things a little bit better. They're basically like cousins, brothers together. So the PPO sometimes is a little bit more friendlier for larger fluctuations. But in general, that's what you do. When you're putting the big picture together, let me just summarize this because this video is not about showing you the fancy indicators of ADX and the MACD and the Bollinger Bands and the RSIs. It's not about how to use them because I could spend hours on just each single indicator, but really you're only going to use them for about 5 to 10 minutes a week, if that. Okay? And that is simply because they're lagging. They're typically behind. Instead, the big picture overview of how you should use these things, get rid of everything on your chart. Okay, so you get rid of everything except volume. You put the 20-day volume average on there, 20-day because it's 20 trading days. Get rid of everything else, Bollinger Bands. You put one moving average. You could use the 20-day. You could use a 50-day if you're trading longer term, more than, let's say, 60, 90 days. You could put the 50-day on there. I use the 20-day because it gives me a little bit more signals, but you could use the 50-day or 100-day or 200-day. It just depends on the length of your trades. So you have these now indicators on there, and now you start learning about price. And what you're doing is you're learning, okay, the price spread, okay, little bar, little price movement versus larger price movement. Okay, so you have a larger price movement versus you have smaller price movements and tighter price movements. So all these things are to take into account, and you can really get an indicator from all these things. Mentally draw your own indicators. Large price movement versus smaller price movement. Okay, large price movement versus maybe a couple smaller price movements. And typically after smaller price movements, you'll notice after smaller price movements, you'll probably get a larger price movements because stocks digest and then they power higher. Okay, unless you get a major down whipsaw and then a major whip back up. So typically, that's what you're doing, and that's what you're looking at when you're trading and when you're doing this. Is you're first looking at the prices, then you're looking at the volume. How does the volume act in conjunction with the prices? Because volume will tell you how much energy and strength, just like these RSIs, just like these ADXs and so forth, the strength, they'll tell you the strength of the move. The larger the volume, so very simple. Let's just look at a volume surge here. If we look at the surge in volume, you can see the larger this volume surge, just look, if I stretch this graph, the larger the surge, the larger the spike in the price. Okay, you could see that we've had very little volume before, and then we get this volume spike. So what do? We get follow through, and that's what happens when it comes to the volume, the confirmation. And then after you do all of that, that's when you start adding in an indicator. But you don't do that till, a year or 2 years or a couple of years later, until you've already kind of have a good foundation on the volume, the price, the behavior, and getting the idea of all of these things working together. Then you can slowly start adding in these indicators. But don't jump into a lot of these indicators right away because they're only going to confuse you, especially if you have a bunch of them. on screen. They just will confuse you. You don't know when to take a trade, when to get out of the trade, and it'll play tricks on your mind and really tear you up emotionally. So keep it really simple. Keep it as simple as possible. Create a system for you that's consistent, and it's all really just about finding which one works for you. Just choose. You don't need 10 indicators. You just need one or two. Just one. One will be just fine. And then, it might help you out in a few little instances where you're just unsure of a stock. Now, typically when I first started trading, if I was unsure of a stock, when I looked at just price action and volume and the behavior, I would move on to the next stock. There's plenty of other stocks, okay? So find one that works. If you have to resort to an indicator to make a trading decision, then you're not sure of the stock yet, okay? So then you need to take a step back. Don't make your trading decision based on this. This is to confirm your decision, to confirm your analysis. Okay, so first, look at it, make your decision, evaluate the stock, price, volume, behavior, all that. Then, once you've made your decision, you can use one of the indicators to confirm that analysis. But you shouldn't be making your trading decision based on the indicators because typically, number one, they're lagging. Number two, they're less reliable. There's fake out signals, and they're a little more difficult to use, and it'll play tricks with you mentally. So I hope this gives you a little bit of insight into these trading indicators and how really they should be used. I know that a lot of people talk about indicators. There's a lot of indicators on people's charts. There's a lot of videos on indicators, but there's not a lot of videos on how to properly use the indicators in conjunction to your trading. And that's really what I wanted to cover today. So I hope this was insightful because these indicators, again, you're spending just a few moments on these, you're just confirming your analysis. The rest of it should really be, your homework. You got to do your homework. After that, you look in the back of the book and just double check a few things, but that doesn't mean the person that did the answers in the back of the book is also correct. Sometimes they're wrong or it's a misprint or they did the calculations incorrectly. But in general, that's what you're doing. You're double checking things with these indicators and just seeing if your analysis is on par. So I hope this was helpful. I really appreciate you joining me, sticking with me, as far as watching these videos and reaching to episode 100 here. I know we've done tons and tons of videos here, even more so than 100 episodes, and there's just a lot of things I would love to do. There's a lot of things I would love to do to grow this channel, to grow the education side of things. For example, the webinars, really would love to get that going. It's just still trying to wrap up the options course. I'd love to write more books. I'd love to just connect with you guys, especially the people that I've done consultations with and done one-on-one coaching with. It's amazing, but unfortunately the time is limited and it's really tough to squeeze those things in, especially with some personal time as well that I need to just balance everything out. So I want to tell you that I just truly appreciate you guys sticking with me, especially the people that comment, that thank me, because really that's where I get a lot of positive vibes and positive energy from, because then I know what I'm doing is helping you guys. And just remember, it's a win-win relationship. It helps me as well to just continue to refresh my own memory, to refresh myself and drill things into myself. It's almost like I'm talking to myself sometimes hey, I need to keep focused on the simple things. Stop going into these wild and crazy things. And sometimes when my trading is off a little bit, it's probably because I'm doing something incorrect. So it keeps me in line also by teaching these classes and these lessons. Now, I've done years upon years of studying, of course, and now most of the things that I really practice, it really comes down to discipline. And that's probably the number one thing that now I focus on is discipline. Discipline, risk management, discipline, doing what I know best. Initially you're going to play with things. You're going to try to figure things out like the charts, like these MACDs and Bollinger Bands, RSIs. But then later, once you find your edge, once you find what works for you, you got to stick with it. So in either case, if you're still searching, don't give up. It takes a little bit of time. If you find something that works just a little bit, tweak it. Don't look for something completely differently. look for improving that thing, okay? Because it's not like a business owner where, they start a business and, well, it's not making enough money, so let me drop this business and start a brand new business. No, you grow the business, okay? So that's what you need to do. You need to grow your education, grow your strategies, and that's the same concept. So thanks again. If you enjoyed this video and you want to make sure you're on the newsletter list so that way you don't miss any other episodes, as well as, you can get new announcements and things that I have planned through that newsletter list, because that's where I typically announce things. So make sure to get on it, and you can just click the button here on screen. And we have a few great things coming out here for release. Sometimes I do free promotions and giveaways as well. A lot of the books and things like that on the newsletter list to those people. So be sure you're subscribed. And in the end, remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.